welcome to the webinar of Innovation, Productivity, and Challenges. Today, we're very happy to have Tong from Cornell to tell us about blockchain without crypto. The floor is yours, so you have 25 minutes.
Thank you, Michael, for the introduction, and thanks to Bernie for including the paper. I'm just going to share my screen. So I'm just going to delve into the slides. Even though the paper's title is blockchain without crypto, I'm going to start with crypto. Thanks a lot for including the paper on the webinar series. I was just saying, I'm going to start with cryptocurrencies. I'll move to blockchains without crypto. There's a reason why people have been focusing on blockchains with crypto, because the crypto aggregate market has just re-hit $2 trillion recently. And basically, this is not only about Bitcoin, right? Even before 2008, for decades, we've seen increasing digitization, more demand for peer-to-peer interactions, and the rise of gig economy, on-demand economy, something our discussant Greg has done important work on as well. And we've looked at how blockchain is essentially providing a more decentralized version of consensus recording of what's going on in the system. And if the recording is about payments, that's blockchain with crypto in many cases. And nowadays we do see DeFi, decentralized finance protocols, on the rise as well. And if you're interested, Cam and co-authors have this a new book that's quite interesting as well. Now, if I want to talk about cryptocurrencies, they are not all crypto tokens or cryptocurrencies are created equal. There are different types of crypto tokens. That's not the focus of today, but roughly speaking, we can categorize them into platform tokens, where the tokens are used as means of payment on platforms, providing certain functions, right? Filecoin will be decentralized storage, like Dropbox. Dfinity will be decentralized computation. Chainlink will be decentralized Oracle network. And we've look at how tokens would play a role in that setting. And if we take this platform to the extreme to be the general economy, then we have the general payment tokens. Bitcoin would fall in that category. Central bank digital currencies, ECNY, and many stable coins are designed around that. And there are many interesting economics related to how traditional central banks maintain or carry out monetary policy, so on and so forth. Many of you have heard about non-fungible. That would be ownership or product tokens. These tokens are not used as means of payment, but they are really claims to ownership of a digital art form or a product or service. My United airline mileage points would be one example, right? And finally, there's also the security token category, where this is just tokenization of cash flows. And we know how to think about their valuation. It's just about cash flows. In a separate study, my co-authors have looked at the factor pricing of these tokens. And what is important is that we do find strong segmentation across the 4 different categories of tokens. So we've known quite a bit about cryptocurrency return dynamics, so on and so forth. We've also known their economic functions in some sense, how tokens can bootstrap a digital network, how it can help stabilize user base. And it can be used as a corporate finance toolkit. It's essentially, if we view the platform as a firm, it's essentially using a liquid instrument to manage its slack, to optimally time when to invest and grow the ecosystem. But different from traditional corporate holdings of cash or liquid instruments such as treasury bonds, the monetary policy carried out by the platform is going to have an impact on the pricing of these liquid instruments. Whereas for traditional firms, the fact that I'm holding a treasury bond or US dollar doesn't affect the pricing of US dollar, right? So there's a lot of interesting stuff going on, and a lot of the attention has been devoted to kind of sources of value for these crypto tokens. and sources of volatility. And safe to say, the kind of monetary supply policy of tokens within ecosystem and the endogenous adoption of the platform would all matter a lot. And more recently, we've seen the rise of staking, where you lock up tokens and get a yield. Many of you have heard of yield farming. There's a intrinsic link to international finance or forex market. If you view these tokens as currencies on these platforms, which can be viewed as cyber countries in some sense, we can talk about carry trade or violation of interest rate parity, so on and so forth. So that's all very interesting. So interesting that the founder of Binance can't help but tweet it on the first day of Chinese New Year this year. Jiao, you can't have blockchain without crypto. By the way, he's the richest Canadian, I think, still right now, at least at the point of tweet, and the 14th richest guy in the world. So, I think he's trying to emphasize the importance of payment innovation within blockchain system. But we can't forget that blockchain is just a technology. It's a database, right? More distributed database. So it doesn't have to be associated with recording payments or transactions or serving as the backend for a cryptocurrency or token. And that sentiment is shared by many executives, and from this Causal et al. Survey, and also a number of anecdotes, people have been talking about how blockchains could be very useful as a database. However, large sample empirical evidence for the value that blockchains provide without crypto is very limited. There's a number of studies either theoretically talking about the possibility of using blockchain as a database to potentially help with secure multi-party computation, for example, or designing such a system, or empirical studies on market reaction to announcements or plans of using blockchains. But the actual usage, how beneficial that is still relatively unknown, except for this paper by Cheng and Luo looking at a Chinese firm using blockchains to help with the issuance of ABS. But that's just for one firm, right? So what we want to come in to provide is to look at large cross-section of firms that are using blockchains as a database. And we're going to look at Chinese firms because this is actually a very clean setting in the sense that the Chinese government does ban cryptocurrency. So we are without cryptocurrencies, but the government is very open and encouraging about blockchain innovation. This is also related to the literature on nowcasting, right? Using, say, Google search volume or web traffic, parking lot occupancy from satellite images. And of course, when we control for these known nowcasters, we have to use the Chinese version. For example, we use a Baidu search volume instead of Google search volume. But safe to say, there's a number of nowcasters that are very well known, and we definitely want to look at them as well. So let me quickly go to the data. We obtain data from a blockchain service platform, a very big one. You probably can guess the name. We're not allowed to say the name publicly. It's providing the backend for firms that want to form a, let's say, a permission blockchain, basically a club of potentially suppliers, customers, or lenders, borrowers, when they want to form a blockchain. And they do have a category of blockchains where they label public open. I'm going to show a picture on that, which is not the public or permissionless blockchain that we typically have in mind, where anyone can enter anytime, but it's open or public in the sense that when you pay a membership fee, you can join that club. So it's not exclusive relative to other permission blockchains. And that open blockchain occupies about 10% of our sample. So we basically observe the blockchain data from 2015, but because we are constructing year-on-year quarterly growth, the first observation will be 2016 Q2, and the average blockchain data size for the firm will be about 600 terabytes. We merged the data with information from SISMAR on public firms on Shanghai and Shenzhen exchanges, stock exchanges, just to get the stock return information. They're merged using the social credit score identifier. So we have over 1,000 firm observations, and we have on average over 500 firms observed per quarter in our data. And on these blockchains, firms typically upload their data voluntarily. It could be very high frequency. They can upload daily sales. In the paper, we describe a few cases where a glass manufacturer for car glasses might be uploading their daily operation expenses, and the automobile companies might be uploading the sales of particular types of cars onto their joint blockchain. Okay, and there could be banks, VCs, and startup founders, so on and so forth. And these pictures are just showing a aggregate kind of growth in terms of number of firms in our sample, as well as average blockchain data size of the firm. And in the latest version of the paper, we do kind of zoom in a little bit to look at the type of data that are being uploaded onto the blockchain. They can be classified into operations, IT, marketing. We didn't do the classification. The data provider or backend service provider did it. Here we're just showing the percentage of these different categories. As a percentage of the overall data size of a particular firm uploading data on chain. And here, I'm just showing a picture of an example of open blockchain. It's in Chinese, but it essentially means open or public. It still says a consortium or permission blockchain. So it's not the full public blockchain that Bitcoin or Ethereum are. Okay, so safe to say the data is more nuanced. We are not looking into the heterogeneity in terms of data type too much, but even with a very simple metric, we get a lot of mileage, and that's what we are doing in this paper. So the key variable we're going to use is actually this on-chain data growth. It's year-on-year to get rid of seasonality effect. It's basically the size of blockchain data for a particular firm I in quarter Q, divided by a year ago, the same quarter, taking log. So it's a growth metric, and that helps us to get rid of any differences in different industries, right? Some industry might have more data overall, so we can't look at the level per se. In terms of firm fundamentals, we look at the standard metrics, return on assets, asset growth, sales growth, patent applied, patents granted as innovative outcomes. The patents that are from DataES, a fintech startup firm, no longer a startup, it's actually a leading fintech firm in China. We look at earnings surprises, the standard measures, and we also look at a number of nowcasters. When we come to that table, I explain more. SEAG will be just Baidu volume search growth, and APPG would be the app traffic growth. And SPG would be credit card spending, and CRG would be parking lot occupancy growth, right? From, I think it's from WXWY, a third-party data aggregator. The key specification we have is essentially the following, right? If we're talking about a quarter Q+1, by the end of the quarter, we do observe this BDG, blockchain data growth. But the fundamentals of that quarter might be announced only next quarter, right? So what is available is actually the firm fundamentals in quarter Q. And what we care about is how this BDG helps forecast or nowcast the firm fundamentals in quarter Q+1 as well as Q+2. So here n is equal to 1 or 2. And that's the simple regression we are running. So what do we find? If we look at firm fundamentals, BDG definitely has a very strong forecasting power on actually across the board, whether we're talking about nowcasting in the same quarter or forecasting for the next quarter. One thing I do want to highlight is here the causality is not as crucial. It could be that the same quarter fundamentals are leading or causing the BDG to have a big number. But the fact that BDG information is available in that quarter, whereas firm fundamentals are only known in the next quarter, means BDG can still be an effective nowcaster or forecaster for firm fundamentals. And to the extent that market participants only react or impound the information of on firm fundamentals into stock prices when the firm fundamentals are announced, BDG is still going to forecast stock returns. Okay, so this table is just showing once we control for these firm fundamentals lag value, BDG still has forecast power. It's a long table. I'm just showing the second half here. And what about if we add all these well-known nowcasters from other studies? Well, those studies do reveal these alternative data-based nowcasters can help forecast firm fundamentals and stock returns. We first have to construct their Chinese version. And we do verify some of them are effective, for example, parking lot occupancy or search volume growth. They do help nowcast these firm fundamentals. But on top of that, BDG is still having a pretty strong forecasting power across the board. So that's what we observe. We can look at how BDG is forecasting earnings surprises. We can use the standard unexpected earnings or cumulative abnormal returns. It kind of hints at the BDG information is really operating through this cash flow channel, right? It's leading to these earning surprises. So in the paper, we have a longer table listing all the controls, but again, we see very strong positive predictive power of BDG. Here's just a continuation of the table. What about stock market reaction? Well, if we sort these firms based on their BDG into quintiles, where P5 is the one with the highest BDG, what we observe is both the P5 portfolio and the long-short portfolio of P5 minus P1 is going to give us a high excess return after controlling for standard factor models, Ho-Hsiu-Zhang 4-factor model, Liu Stanbov Yuan 3 or 4-factor model for the Chinese market, so on and so forth. And this Sharpe ratio is also reasonably high as a predictive in a predictive exercise, right, over 1 with the stock forecasting exercise. So I think I am about time, or maybe I have a couple more minutes because we started a little bit later. So let me just quickly mention.
Yeah, sorry, you still have. My apologies for everyone that I had a watch problem. You have another you have 4 more minutes. Sorry.
Okay. No worries. Yeah, thank you. That's good to know. So how do we understand this? Right? Can we think about what potential channel this might be operating? So one helpful exercise is to look at the heterogeneity across firms. We do find BDG seems to be more effective, or the forecasting power is more significant, both economically and I think statistically, when the firm has less state ownership, smaller in size, when they have less analyst coverage, and lower institutional ownership. And in the latest version of the paper, we also look at firms actually with very low competition in that space. Well, sorry, low HHI, that means there's a lot of competition. They tend to benefit more from BDG. And what that means is these are firms that are potentially more opaque, less trusted because it's not state-owned and it's covered less by analysts, it's smaller, and there's less institutional ownership. And that ties us to how BDG could be operating. So if here I'm just showing this heterogeneity analysis gets through for both fundamental forecasts and also stock return forecasts. So it could be telling us that blockchains as a more distributed, immutable linked list database help us to create an algorithmic trust for participants in the ecosystem. They can potentially reduce informational asymmetry as well as mitigating agency issues, right? Because the uploads of information is more continuous. So maybe that reduces the short-termism of certain reporting practice. And it can also save costs in terms of monitoring. The fact that you can't go back and retroactively modify or manipulate data also increases trust within the ecosystem, right? If I'm a startup founder, I'm about to raise financing, the fact that I'm uploading my kind of daily growth of user network would be helpful when I talk to potential financiers. Now, we are not going to push too much on the causality here, but we could construct instrumental variable as well as doing a propensity score matching to look at diff in diff when firms adopt blockchain, and we do see consistent evidence there. And in the interest of time, I'm going to skip that. And finally, we do a number of exercises to look at observability of the data, right, by restricting our attention to the subsample where we have those open permission blockchains. And the forecast power is still there, so it's not fully priced in, even when most market participants can have access to the data or to the information. And the findings are robust in subsamples across countries where our data provider have operation. In Indonesia, Malaysia, Thailand. In South Korea, it's less significant, but all other findings are consistent. And sometimes it's not about individual firms. It's actually about a whole supply chain or all the members within a permission blockchain. When my fellow members increase their blockchain data on chain, it can actually positively forecast my firm fundamental changes and stock returns. So with that, I'm going to stop here. Basically, we show that BDG, blockchain data growth, positively forecast and nowcast firm fundamentals and stock returns. And there's some suggestive evidence that it does this through potential increasing trust, transparency, so on and so forth. And this is essentially a first large sample evidence of how blockchains can provide value or can operate without crypto. The paper is still quite preliminary, so all comments and feedback would be much appreciated. Thank you.
Well, thank you, Will. And again, my apology to the whole audience that I have a timekeeper problem. Sorry about that. And now let us invite a great BUCHAK from Stanford to do the discussion. And thank you, Will, for a very clear presentation. Greg, the floor is yours. 25 minutes.
Great. So thank you very much for the organizers for giving me the chance to discuss this super interesting paper. This topic of data and firm behavior and firm performance has really been on my mind, and this paper actually made me think of it in a sort of completely different angle. So it was a pleasure to read. I highly encourage everyone here in the audience to go and take a look, and you'll definitely learn a lot from the paper. So kind of to give my own motivation or my own take on this, let me start with this very striking chart, which is showing Facebook, aka Meta's stock price. And as you see, there's this huge price drop near the beginning of 2022. What happened here? Well, this is when Facebook announced that their revenue took a huge hit because of new Apple iOS privacy policies that restricted Facebook's ability to collect and use user data. So I like that. It sort of illustrates very starkly that data are increasingly seen both by firms and also by investors as super important in determining firm behavior and also asset prices. And they're sort of an incredibly important input into firm performance. And correspondingly, there's like sort of this growing literature out there that's trying to think about how firms can use data to their advantage. So maybe they use the data to make production and management decisions. Maybe they use it to address sort of classic financial frictions like screening or marketing to borrowers. So if you think about it, all of these data use cases are very sort of profit focused or customer facing focused. They're about how the firm uses data in its customer facing production process. And in other words, they sort of teach the firm about customers, or they teach the firm about the market. And I think what this paper is going to do is sort of think about data from a slightly orthogonal use case, which is how the firm can use data to credibly inform investors about the firm itself. So in other words, we're not learning, it's not the firm learning about the consumer, it's about the firm using data to teach investors about the firm, to put information about the firm's performance or management out there. So the basic idea here is that data about the firm can alleviate a lot of the very classic kind of corporate finance frictions, like we teach our PhD students or our MBA students. These are going to be things like using data to resolve information asymmetries, inform investors about the hidden state of the world inside the firm, or maybe solve incentive problems, data that sort of bring data to light that would shed light on sort of management expropriation or lying or sort of bad action. But there's a sort of basic technological problem here, which is that somehow the firm needs to, if they want to reveal data about themselves to the market, they have to be able to do that in a credible way. Okay, and the basic problem, of course, is that unless there's some technology to solve this problem, the firm can just sort of lie or alter the data ex post. The old school technology for doing this is like an external auditor. Okay, so the accountant comes in, they look at the books, they put out the 10K. Of course, that's kind of slow, that's expensive. We're going to be learning about the firm very slowly. And perhaps maybe the fidelity of the data that the auditor reveals is sort of lacking. There's another alternative, which is sort of what this paper is thinking about, which is to use technology like the blockchain, which is partially but not totally immune to some of these like lying or changing the data ex post issues. And so how does blockchain solve the problem? Well, it's going to depend on what you put there. But for example, if you're using the blockchain to do kind of real-time data reporting, which is one of the examples Will shows, this isn't something you can lie about or change later. It's on the permanent record. Or alternatively, you can put sort of higher fidelity data on the blockchain, like individual transaction records between you as the firm and your potential customers. You can use this information, or sort of outsiders can use this information to make inferences about firm performance. If there's suddenly a lot of data on the blockchain, it means they must be transacting with a ton of customers. And that's sort of a good sign about what's going on at the firm. And that's something that's really hard to fake or falsify ex post. So with this idea, the paper is going to look for sort of preliminary evidence of this idea of using data to enhance firm value and inform investors about what's going on. We're going to look for that in the data. And kind of two questions is, does the firm doing things on the blockchain, putting data on the blockchain, predict and perhaps cause, and I'm going to spend a lot of time thinking about the interpretation here, improvements in firm fundamentals in this sort of now casting sense. And then from an asset pricing side, it's going to ask whether firm blockchain use ends up showing up in asset prices. They have a really nice setting, as Will told us. This is sort of blockchain without crypto. They're going to look at data use on blockchain as opposed to like issuing tokens and getting value that way. Having the data on blockchain allows for this sort of real-time credible information reporting that I have in mind here. So the main findings are going to be that more blockchain use for data is associated with better firm performance. This is true in terms of firm fundamentals. They look at like so many things, and the findings are really incredibly consistent. It forecasts more asset growth, sales growth, return on assets, and so on. And then also in terms of asset pricing, this sort of standard kind of like long short approach, they're going to find that it forecasts better returns. Okay, and then to support this sort of credible disclosure mechanism, which I think is really sort of the interesting potentially causal claim here, they're going to find that, for example, the results are stronger for firms where we think this might have more bite. So think of like smaller firms or more informationally opaque firms. So that's sort of like the paper in like super high level. Will did a great job of walking you through it, and I encourage everyone to take a look. What am I going to do in this discussion? I'm just sort of going to quickly refresh you on sort of the data and the setting and what I view as kind of the main kind of, I'll call them predictive results. I should say here, I'm basically 100% convinced that these predictive things are true, that blockchain use is associated with better firm performance in all of these ways that they measure it. It's an extremely thorough analysis. They do tons of results, tons of robustness checks. So there's really a lot there, and I'm basically completely convinced. I think where I'm going to have the most comments, and these aren't really negative. It's more just sort of what's the sharp interpretation that you want to bring out is sort of, do we want to think of this as causal? Are there causal claims you want to make here? And then to the extent that there's a little bit of skepticism, I have some thoughts on how you might try to sharpen that up and bring more light to that. But I think these are things you could like definitely do. So hopefully this is constructive and not just sort of throwing stones. So the setting is China. They have data on essentially the quantity of data that's on blockchain. They have a panel of like tons of firms, and they're going to measure this at the firm quarter level, this quantity called blockchain data growth, which is just the log 4-quarter change in the amount of data that firms have on their public or sort of protected use blockchains. It's more or less real-time data, so they can get it a lot sooner than a lot of these standard accounting variables. I think what you seems like is now in this current draft of paper, but like what I think I would really like you to exploit a bit more is they actually sort of tell you what they're doing with the data on the blockchain. So it looks like they will tell you, is it accounting data? Is it sales logs? Is it sort of other random data that's kind of relevant for the operation firm? Like maybe it's not actual sales, it's sales leads. Maybe it's some R&D data set that the firm has been using. I'm going to talk about this a little bit later, but I think that's a really interesting aspect of the data set that you mentioned, and you could really get a lot of mileage out of in terms of interpretation, and if you sort of push that a little bit harder. So I think, as I said, sort of what they're actually doing with this data is going to be really informative and tell us how we should think about this. So this is what the data looks like. This is the average quantity of blockchain data for sample firms. You can see this like increasing really steeply over time. And it's not just that like firms have more data. If you look at the amount of data that firms have on the blockchain, it's a fraction of their sort of total cloud data. That's also increasing. So not only are firms sort of like, as they're operating, collecting more data, they're also putting a greater share of that data on the blockchain. Okay, so that's sort of that's the data. The what I'll call the predictive results, and Will showed you this. Essentially, blockchain data growth predicts incredibly strongly all of these sort of good outcomes in firm fundamentals. So they look at tons of things: returns on assets, asset growth, sales growth, number of patents, PP&E growth. There's a ton that I'm not showing. It's essentially a universal finding that they're going to get, where more data on the blockchain is super strongly predictive of sort of better firm growth. They do this heterogeneity analysis, which I think is super interesting, sort of asking whether these effects vary by the type of firm. The main cut that like I think is interesting, and this is sort of what they do, is ask whether these effects are larger along various ways of measuring firm like information opacity. So they're going to ask whether small firms, where maybe giving more insider view into the firm would be more sort of relevant or more revealing about what's going on at the firm. Stronger effects for small firms, stronger effects for firms that are operating in, say, less competitive industries and sort of might be more opaque because they're not facing these sort of more competitive pressures. Again, pretty universal finding that this relationship is there in the data. And then they'll do this really interesting horse race with other of these so-called like nowcasting variables or digital economy variables. These are going to be things like parking lot occupancy that they get from, I guess, satellites. employer ratings, credit card spending of the firm, and so on. And basically the predictive power of blockchain data growth is going to survive all of this stuff. So it's a very, very robust finding. There's a bunch of asset pricing results also that Will went over. I'm not going to get into a lot of detail there. What I really want to do is kind of spend the balance of my time thinking more about the interpretation. And I really see sort of three ways of taking these results. I think all of these ways are like interesting in their own right. I think what my sort of main suggestion is to pick one of these and sort of try to sharply identify it. And so I'll sort of tell you the ways that I think about what might be going on here. So one is sort of like a purely predictive interpretation. And I think Will is pretty humble about what their findings are and not pushing too hard on things besides that. But it's sort of like the idea is there's good stuff going on at the firm. Good stuff going on at the firm generates, so think of like there's a demand shock and then the firm is just interacting with more customers. That's going to generate a lot of data. That data is going to show up on the blockchain, and then we can use that to predict sort of outcomes of the firm ex post. Okay, so the firm gets more data, they use more blockchain, either they adopt blockchain or they just use it more extensively to ingest and record this data. In that case, the results, both sort of the asset pricing and fundamental results and the data use, are jointly caused by some good firm shock. And we're not really trying to explain where the good firm shock came from. It just sort of happened and it led to like more sales and also more blockchain. And it's very great that we can use the blockchain to predict that this is going to show up. There's then sort of what I'll call like a weaker causal interpretation, which is something like data per se improves firm performance, not necessarily blockchain data, just sort of data. And the idea is sort of the act of collecting data, using data is good, and firms that do that do better. For example, having more data lets you make better managerial decisions. Once you start using more data, you start making these better managerial decisions. Having more data lets you understand customers better or make better products, or basically just take actions that make the firm perform better. This, by the way, sort of has the flavor of a lot of the literature that's sort of thinking about data as causally useful in firm production or how firms interact with customers. So it's causal. It's not exactly like a blockchain story per se. It's more of like a data story per se. And what you're doing here is getting a very good measure of data. And then there's sort of the stronger causal interpretation, which is blockchain per se, as opposed to sort of other ways of keeping or reporting data, actually improves firm performance in a causal way. And the mechanism here is sort of what I led off with, which is the technology of blockchain kind of solves some data reporting information asymmetry problem that allows the firm to credibly tell outsiders about what's going on at the firm. It allows them to credibly signal. It allows them to credibly report performance. It allows them to credibly sort of self-monitor. All three of these, I think, are like super interesting. I don't think the paper sort of survives on one of these being true and ruling out the other ones. I think it would be nice in my mind, to sort of take a bit of a stronger stance on like which of these you want to push and then sort of go for it. So they do a little bit of this sort of causal identification. So they're going to do this IV analysis. The idea here is to use this idea of industry spillovers. If a lot of firms in my industry are using blockchain, I'm going to learn from that and adopt blockchain. Very, very strong first stage. And when you plug this in as an IV, here it's sort of like a nonlinear thing. So they do this control function thing. Same idea. They're going to find quantitatively similar results to what they find in the OLS. So again, more blockchain data instrumented in this way leads to more better firm performance. So why am I not like totally convinced by this? I think the relevance condition here is clearly satisfied, and you check it in the data. The exogeneity condition seems a bit trickier. So basically, you sort of still need blockchain adoption to be unrelated to these unobserved performance or demand shocks. And this time it needs not to be at the firm level, but at the industry level. So you can sort of easily tell a very similar unobserved shock story that I told you at the firm level, also at the industry level. So the industry gets a good shock, say all of a sudden everybody wants to buy shoes or iPhones or something. They get more customers. As a result, all the industries in the firm adopt blockchain technology to handle the data, or maybe they even do this in anticipation of a good shock. So this good shock improves fundamentals industry-wide and also causes blockchain adoption, but it's not blockchain adoption per se, which is improving fundamentals. You would like to include like industry time fixed effects to absorb something like this, but the problem is that the instrument's variation is at the industry time level. So it's a little hard to do something like that. They're also going to do this nice diff and diff analysis, which is the idea of use kind of like the staggered adoption of blockchain at firms. And the preferred interpretation is going to be that blockchain adoption timing, if you think it's exogenous, then that we'll be able to interpret that adoption and effect as a causal thing. Again, I think there's sort of like the similar identification problem. There's like firm time level shocks that move around fundamentals that are also going to induce firms to adopt blockchain. Okay, so I like that you're pushing in this direction, and now I have a few ideas that might help push a little harder. So first, I think it sounds like you have this data. I think the story would benefit a lot if you use that. So is it data about the firm? Like, is it firm accounting fundamentals, or is it data that's generated through the firm's interactions? If it's the former, it feels much more like a story about improving the information transparency of the firm. And then the sort of causal story or the sort of Bitcoin increases firm value story kind of makes sense. If it's the latter, like it's data that's generated by the firm interacting with more consumers, that feels a bit more like the correlation story, which is, a lot of data shows up on the blockchain when the firm is engaged in a lot of transactions, and that's all being driven by the fact that the firm got a good shock. So I would encourage you to sort of do some heterogeneity analysis around this. I think we'll learn like just from this like simple data split or like a simple interaction, we'll learn like a ton about what this data is and like plausibly why it is making a difference for firm fundamentals. So my next suggestion is sort of a variation on the instrument you've been using. So rather than exploiting industry spillovers, you might try to exploit something like knowledge spillovers within a geography. And so there's a couple of ways you might think about doing this. A really simple approach might be to say, okay, the use of blockchain is going to sort of spread out from a tech hub like Shenzhen. So the instrument for a given firm is like, how far away from Shenzhen are you? It might work. That will give you some sort of cross-sectional heterogeneity. And then what you would do is interact that in some sort of either direct like cross-sectional test, or interact that with some sort of key event in time, like the first time that blockchain becomes big, or some regulatory change that lets firms like start using this somehow. And then you'll have some sort of post times distance from Shenzhen, and you can interpret that that adoption is like a little bit more exogenous. Another way to do this with a more obvious time dimension would be something like use the time that a large local firm adopted blockchain, and think that, okay, from that large local firm, maybe in different industries, but the local firms will now start using blockchain after that happened. And so you have something like post IT is one if a local firm adopted blockchain prior to time T. And so what's nice about that setup is you can utilize like industry time fixed effects to handle a lot of the like industry shock things I had in mind. If you want something like even more granular, you could say, okay, there's going to be a local spillover within the industry. So, post IT is one if a local firm in the same industry has adopted it, then you can include both industry time fixed effects and also like local time fixed effects, and try to absorb sort of anything that like the identification police might want to throw at you. So the point is, I think you have the variation in your data to try to generate some more plausibly exogenous variation in who's using blockchain. And I would encourage you to push in that direction a bit. I'm pretty much out of time, so I'll send you the slides and you can look at these sort of other random thoughts. I just want to conclude in like the minus 30 seconds I have. So super interesting paper that gives a lot of nice and novel evidence of sort of blockchain is a really good nowcaster of firm fundamentals, and has some sort of nice asset pricing predictions. again, the analysis here is like extremely robust, extremely detailed. They looked at so much, and I certainly can't do it justice in the time I had. So I encourage everyone to take a look. My main suggestions, I think, are sort of to try to like pick one of these interpretations and sharpen it up a little bit. I threw out some ideas. I'm sure you can think of some better ideas, but I think especially it would be useful and sort of an easy thing for you to do is just delve a little bit into what's on the blockchain and sort of heterogeneity around that. But overall, really, really nice paper. I learned a lot. It really changed sort of how I thought blockchain could be used and data could be used more generally. And so I hope everyone in the audience will take a look, and I'll stop there.
Thank you, Greg. It's a wonderful discussions. It help us all to understand better the paper. Will and Ray, I'll give you time to respond, but let's see if there's any comment from people first. For example, Chen Chang has already written papers along this line, Michael. So let me turn to the audience to see if there are questions. May I do that? Any questions from the audience? Michael, please.
Yeah, so well, this is a fascinating paper, but Greg has already said all I want to say. This is a fantastic discussion as well. I just want to ask a question from a slightly different angle. That is, well, can you, and your co-author, Ran, can you tell us a bit more about the other side of the story? That is, for instance, if we argue that is a data trustworthy issue, then is there any alternative way for firms to make their data more credible in a traditional way? Say that, for instance, if you think about the offline shops, they can do advertisement, car dealers. There are many ways for them to make their data credible. And compare with, say, Taobao sellers, their performance and their data might be harder for outsiders to get. So in that sense, I mean, on the one hand, I totally agree with what Greg suggested. On the other hand, I'm just trying to think about if there are other ways to get some exogenous variations about the adoption of blockchain technique. Say you can see, or you can tell us a bit more about the stories, so that we can get the message more precise. Okay.
Will you want? I have my own questions too, but would you want to respond to Greg and also to Michael? Then we take other additional questions afterwards.
Yes, absolutely. Many thanks to Greg for the wonderful discussion, and also to Michael for the question. We can ask for more from a discussion, right? I think there are clear paths forward. The type of exercise that we can do, and I think Greg is all the points are really well taken, and it's right on target. We've been struggling a little bit. Do we kind of push the asset pricing angle more, or kind of causal, corporate finance type of route? But what you laid out is definitely worth exploring, and that's a good kind of direction for us to see if we can tease out more causality. Just kind of related to the type of data, there's one reason that we didn't start with looking into more details of the data is that it's very blockchain specific, right? For certain permission blockchain, it's fully voluntary, right? VC startup founders versus banks and their borrowers. Maybe there's some mutually agreed type of information that they would disclose. Kind of a common denominator would be this data growth, in the first pass. But as I said, looking into these specific categories is going to tell us a lot. And also, I know you mentioned it's not only about not retroactively changing the data, but even with each transaction, it's just harder to fake it. And it's very much tied to many technologies such as zero knowledge proof, right? The two sides don't have to reveal a lot, but you can still verify certain transactions. So that's definitely one key aspect of the technology. Now to Michael's question. So in terms of competitors or more heterogeneity, right, across different industries, we think blockchain is unique in the sense that it does have this openness. One close competitor is, for example, if we talk about digital data, right? One close competitor would be cloud-based data, which is very relevant. My co-author Ran has a separate paper on cloud-based data, but the issue there is it's not observable to most people, right? It's whoever is running that cloud or owning the data. Whereas even for permission blockchain, the members in that consortium can still observe the data online. So in a sense, blockchain data do bring about this openness or open access to some level. We can control for cloud storage. We can control for some other digitization metrics, such as the use of IoT, so on and so forth. So the predictive power is still there. But to fully answer your question, I think we just have to delve more into the details of the data, like what exactly is recorded online. Maybe for particular industries, they don't report sales as much, but for others, there is a way already to communicate that information to investors, and actually not only to investors, but to partners, upstream, downstream firms. So I think that's consistent with what Greg was suggesting, and we should look into that.
Chang, you seem to have Chang, you want to raise a question, please? Your hands is up.
Oh, thank you, Bernard. So hi, Will. I read the paper before. It's a really interesting paper. Just to have one small comment and one question. So when I read at the beginning of the paper, I kept wondering what data is on the blockchain. You keep emphasizing data. So I think you guys provide the information or the examples toward the end of the paper. I think it will be helpful if you move some of the examples toward the beginning of the paper so that readers know what is really on the blockchain, so that will help the readers to understand the story and the analysis. The question is related to what you just discussed. So who have the access to the data on the blockchain? Some of the, I guess the number of the people who have access to a specific firm's data on the blockchain might vary. That might help you guys to see the predictive power of the blockchain data for future returns. I don't think it will affect the fundamentals, the firm fundamentals. That's just how timely the data is, right? So, but the question is to say, will the people who have access to the data on blockchain come up with a trading strategy like what you guys do in the paper, and then just trade on the data? And so whether they have the ability to trade on the data depend on, I guess, whether there's some confidentiality agreement. Say you have access to the data, but you are not allowed to explore the data or share the data, etc. And then second is to say the number of people who have access to the data might affect the predictive power of the data for the future returns. Maybe you can do some cross-section analysis in that regard. Thank you.
Thank you. Will, I have a question that is really connected with Chang's comment and Greg's comment. So maybe to save time, let me raise my question before you answer all this. It seems that Greg and Chang, and Will too, and Michael too, are really wanting to know more about what are the components in the BDG, what are in the blockchain. And Greg's point is that there are three interpretations. The pure data correlation, better manage the firm has higher BDG, or maybe just the transparency itself push firm to do a better job than before. Okay, that's one point. And then he asks you to decompose the content of the BDG so that you can do a better job and deciphering whether it's just based on whether this are simple operations or accounting fundamentals to allow us to see more about the causality. And Chang moved forward to say, if I am a bank and I have access to the data, I'm going to make my prediction. I'm going to conduct big data analysis. So with that as the base, I start to ask a question. Would this data-driven behavior and also predictive power lead to a misleading behavior? I mean, I understand that this is very powerful in the short term, but in the long term, I don't know. But given that this data is very powerful in the for short-term prediction, and given the possibility of black box in, black box out, you can end up creating a funny kind of new equilibrium that may be suboptimal to other possible equilibrium. So this is something I have in mind. And would it be possible for you also to not just look at firm, look at industry and regions to give us more information on, what is the longer term resource allocation according to this, based on industry and based on regions? Thank you for listening.
Thank you, Bernard. Thank you, Chang, for all the questions. Let me, before I forget, I should give credit to Chang for the IV that they used in their paper. We're definitely inspired by that. So all the questions make a lot of sense. In terms of who observes the data, we did one exercise that is to look at the subsample of open permission blockchains. In the earlier version, we call it public, but it's not exactly public. So those are blockchains where you pay a membership fee. So there's still a small friction for accessing the data. And for that subsample, which is about 10%, less than 10% of our sample, we still see these effects. That means even though people have access, either they don't have deep enough pocket to fully impound the information into prices before earning announcement and all that, or there's just going to be some mispricing that people are not fully exploiting this. So that's one kind of exercise we do to kind of explore this dimension. In terms of the new equilibrium, almost like a Lucas critique type of outcome, right? People are going to react once they know investors are using BDG to forecast. Firms might they're going to report more information, whether it's useful or not, just to increase their BDG. The time series we have is relatively short. We have 5 years, about 5 years, 5-6 years. So we can't say too much about the long run equilibrium, but as Bernard was suggesting, looking into the regions and industries would be one way to go to see, maybe as an industry, it's pretty much zero-sum competition in some regard. So if all firms are all reporting more, we shouldn't see better performance, right? It's almost like signal jamming type of argument. And that's something we can look into. And I think there's also an interesting observation. I think, Bernard, you mentioned banks can utilize data, not only the public investors. And that's something we do observe. When you see the terms that banks offer to their borrowers, when there's actually positive reporting of sales and all that, the terms actually improve. So just anecdotally, we look at a few cases. That is the case. Yeah.
On the side, we are working along this line to propose something to G7 in Jakarta meeting about creating data utilities along exactly the same purpose. There's a clarification question, so please take this question. The question is, do you know if firms also provide auditors access to their blockchain? If so, could it be to increase the transparencies and monitoring that is changing the way the managers report their financials? This is from Amanda in the audience.
Yeah, thank you, Amanda. And that's a question I want to defer to my co-author to see if Ran knows more details about that. I'm not sure actually if they offer the information to auditors, and I don't think that piece of information is in the data that the backend service provider records, but I could be mistaken. Ran, do you know?
Yes, and some data can be accessible to the auditors. Yes.
Let's see, yeah.
To all auditors?
To some auditors in the blockchain, in the consortium blockchains, including the firms, the auditors, the banks, and so on, right? Belongs to the same the blockchain.
Yeah, so yeah.
Yeah,
Sorry,
go on.
I'm just going to add one remark. In the US, startups such as Findora is doing these kind of auditable blockchain. Of course, they do introduce crypto and all that, but that we also see that trend. This regulatory compliance is something that the blockchain industry is actively exploring.
Any other questions? Well, let me take this opportunity. Let me thank Will and Ran for a wonderful paper and a very good, very clear presentation. Greg, you have done an incredibly good job in helping us to deepen our understanding of the paper. Really very grateful. And Michael and Jiao, thanks for your questions. Amanda too, thank you very much. And allow me to apologize one more time that I was late today because I didn't know that my old watch was not working. And now I better throw away my watch. And we are going to have a break because the ABFEL is organizing the main conference face-to-face in May from 23rd to 27th, and it's hybrid. It turned out to be quite a bit of work, and we need to take a break from this and focus on organizing the conference. I would like to let you know, however, that there's something great coming out on July 6th. The paper is going to be tentatively Data Privacy Paradox and Digital Demand by Long Chen of the Lohan, how to pronounce it right, Lohan Academy, and it will be on July 6th. Again, thank you everybody, and thanks for your patience. I have a great stimulating session learning from you all. Thank you. Bye.
Thank you all, and thanks to Greg for the discussion.